Okay. Am I muted?
You're good.
I'm good. Great. Oh, wow, that's neat. This shirt. Wow. Okay. We have covered the first two sections, and I want to see if I can figure this out. If I hit this little button like that. Oh, good. That's not bad. And in these first two sections, wow, we've still got 100 people watching. Thank you all very much. We've taken the idea of what these lines are on this quadrant of a chart that we keep talking about. During the first section, we went through basic rules of Consensio in terms of what we're looking to do. You can construct it yourself very easily. All you need is a piece of paper and a pencil. It's easier to do it with charting, so you don't have to do all the calculations. Just let this chart, or on Bitcoin Wisdom makes it very easy. The problem is you can only do a couple of cryptos and Bitcoin in general. But all the other charting places, Fidelity or E-Trade or any of the other ones, Schwab, gives you tools. You can basically do this. And it's great to take it step by step. I think I've said that after Leah went to the class with Tone to learn the sequential trading system, that we spent some time together with on TradingView where we wouldn't put Tone's numbers on it, but I wanted Leah to do the calculations to figure out what those numbers are. The same thing in something like this. When you're hearing someone talk about it, you will understand or be able to picture certain things, and you'll go, oh, wow, I got that. And then 2 or 3 things later, it'll get fuzzy again. The way to unfuzz it is to actually do the calculations by hand on the moving averages. Take a simple moving average like a 10-day or 10-week or 10-month. It doesn't matter what the interval is, but do the calculations on it. And see when you plot on a 10-day moving average, what each of the 10 days do to the next point on the moving average. So you can begin to picture what these things are really saying. Each of those are calculated by a very, very simple formula, but when strung together into a line, which is called a moving average, you forget what it's really telling you until you can picture the calculations between shorter, intermediate, and long term. Why are they doing it the way they're doing it? You hear Tone all the time saying, here is when this moving average is going to turn down in the future. It's going to be 4 weeks from now. Well, all he's doing is counting back. If it's a 50-period moving average, counting back 50 weeks and seeing what is being dropped from the calculation compared to where it sits right today and what's going to be added on the next week. But that's because he really understands what he's doing. He doesn't have to calculate it, he pictures it. That's what you need to do for Consensio, is don't just go by the rules. I've given you some simple things, 13 on 2 moving averages against price, many hundreds when you add the third line, but they can be simplified in your mind in different ways the deeper you get into it. Just start using it and it'll start coming very easily to you. Okay, what we're going to talk about in this third period is we are going to go into very rapidly because we have 70 some odd charts, which is less than 1 a minute. It doesn't matter because remember, all you're going to do now is you're going to picture these lines, what they're telling you relative to indexes. We just went through about 5. And now we're going to move into other groupings of securities right down to individual securities. Okay, so I need to talk to you instead of show you. So I'm going to take this off again. Here is the way I construct portfolios for all of our consulting clients, all of my fiduciary clients. I break a portfolio into 3 parts. The first part is 60%. The second part is 25%. And the final part is 15%. 60% is made up of the charts we just looked at. Large, broad, diversified portfolios that relate or correlate to very big important things such as economies and overall stock markets. That can be done with indexes themselves in the form of mutual funds or ETFs, or it can be done by you putting together 50 or 75 different stocks into your own portfolio. If they're diversified enough, what they're going to do is they're going to reflect a much bigger story. If they're all tech stocks, they will not. They will only tell you what is happening in one sector of the stock market in the economy. So the 60% have got to be very broad and diversified, and it's much bigger than the other 2 piles. And the reason for that is we're investors. We are taking advantage of long-term trends in the economy and in businesses in the form of stocks and corporate profits. The next pile, 25%, is made up of sectors and industries that are either doing better than that diversified portfolio, and therefore will add to that diversified portfolio what's called alpha, or unexpected returns over and above what a big, heavy, diversified portfolio does. And you can do that, as we will see, sector by sector. 10 basic sectors, some people say 11, doesn't really matter. Each of those sectors are made up of industries. And I've used these examples before. In the financial sector, you've got insurance companies. They act differently than brokerage firms, that act differently than very large multinational banks, that act very different than regional banks. And each of those industries all go together to form that sector. You need to understand that when you're trying to identify things for this 25% bucket of your portfolio. Well, that's 85% of the portfolio. Now, the only thing that you are really risking in terms of moving away from investments and moving closer to speculation is the third bucket, where we only put individual stocks, or we put things like Bitcoin for now. And that's why I say over and over again, for clients that I'm actually managing their money, I will never be putting more than 5 or 10% in any of those one things, one stock, one asset like Bitcoin. In the 25% bucket, I might put 5 or 6 things in the same industry as individual stocks, because I've just made an industry that can fit into the 25% bucket. Okay. I needed to go through that to give you my perspective of what we're about to see. Now we have moved from the 60% bucket, and we're now going to move into the 25% bucket. Sectors and industries using the exact same technique and forgetting what we're looking at, just looking at the funny moving lines. Wow, I did it. Okay. So now what we need to do, this was the last chart we looked at, which was the Russell without the price. So now I've got to come up here and I am going to go to sectors. And these basically are just the big ugly sectors, and we'll start with this big ugly sector right here. Right here. Okay. Same time period as all the indexes we just looked at, the Dow, the S&P, the NASDAQ, Russell 2000. But now we're looking at consumer goods. Consumer goods, of course, are made up of many, many companies in many, many different industries. But they all fall in this general category called consumer goods. Very different picture. Same time frame, same 3, 7, and 30 moving averages. I'll flip price on just for a second, just so you can see I'm not cheating. Pink line, price stays right with it no matter where it goes. It warns you when you're going from up to down, when you're going from up to down, when you're going from up to down, and when you're going from down to up. It gives you early warning that things might be changing. Some speculators or gamblers, that's all they need. Remember, this is a 2-week moving average. Some people can bring these things down to 2 days or 2 hours or 2 15-minute periods, depending on what you are trying to achieve with that asset, and if you're a gambler, a speculator, or an investor. Because I'm an investor, and I think that's where a very large portion of everybody's money needs to be at all times, regardless of what you do in the 25% bucket or the 15% bucket. That's what I am using in terms of my moving averages for this type of a thing. Now, also notice that the intermediate term also seems to be working well with this very volatile consumer goods group. Price in an uptrend stays above it. Price in a downtrend tends to stay below it, except for a couple of penetrations, but they don't last long. That tells you that the timing is good on this moving average with this particular asset. But what you're looking at now is something in which the long-term moving average topped and has been going down since March. It's still going down. We are now in a position in which the price is below the long-term moving average, which is below the intermediate term moving average, and the short-term moving average has cut down through both of them, and price is below it. This is a part of the US stock market that's in trouble. Let's go back. Remember what we looked at when we went back to the 2015 period. And let's take the price off again, because we don't care what we're looking at. We don't care what the name is. We just want to understand trends and trend changes. Going back far enough, we've got a pretty nice looking uptrend. It ran into problems when all those other things did, but then it ran into problems again to a much larger extent that the overall indexes did. and then got back in line for a year and a half. Now is turned down again. The length of time that this long-term moving average has been moving down is greater than this one, is much more severe, but not in terms of time, but in the fact that this one is just going flat. And all the way back into 2013, we never had anything this bad. Now, in terms of how much you've given up, go sideways to see, did you buy here? If you bought here, you haven't lost anything. You can get out, lick your wounds, and say, okay. If you bought anywhere previous to this, you've still got very large profits. What is this going to do in the future? For me, I don't care. I was out of a fairly large portion of this when this long-term moving average moved down. And particularly when these short and intermediate terms came this far below that long-term moving average. Look at the distance relative to this, relative to these little two things and these little blips. Something bigger is going on here. Now, what a fundamental analyst would do is he'd give you 25 reasons and pick out the 10 biggest stocks and look at their earnings and all that stuff. That's great. And I always do that after the fact, not before the fact. You try to understand this before it's done too much damage. We are moving from an uptrend into a downtrend. I don't want to hope that this downtrend turns around. I've already raised cash. What did I do with that cash? That's immaterial. We'll talk about it later in this hour. You don't want to be in this, you want to be in something that isn't going down and you know cash isn't going down. That's the starting place. Okay, let's back it up. Let's take a look at another one and move a little more quickly without all the verbiage. You understand what I'm trying to build here for you in terms of the mental picture of the difference between indexes and sectors. Now we're going to look at consumer services. Are you kidding me? How could two things with the word consumer in it be so different? The last one we looked at, you're getting your head handed to you. Consumer services, and what you need to do is you need to pull out your little book or Google it. Google the iShares US Consumer Service ETF and see what the stocks are in it. You'll see they're very different. You'll quickly be able to see, oh, they're in this industry and that industry. I don't care. If I was in this thing, I would still be in it. And at this point, I wouldn't have taken anything off the table. Some people would say, well, look, this has broken below the intermediate term. In some things, that's important to me, and I would have taken 5% off. I've got people in our consulting group that were talking this through specifically with real money that they've got put in, and they think because of what they're seeing in the NASDAQ and with certain stocks, that because this pink line is cutting through there and they own this particular thing, they need to raise cash. That's your call. In my case, I wouldn't be doing that because I've made conclusions about what the overall market's doing, and I don't really care about these little blips. What do these little blips look like in terms of price? Well, let's put the price back on. That's a big move, but that's a big move that only took you back to previous highs that were reached all the way back at the beginning of 2018. Now, this move this week looked pretty nasty, but look what happened. We came from below the long-term moving average to well above it and closed the week well above it, which means it's not going to turn this down. Now, if we stay down here next week, these are going to accelerate down and I'm going to raise cash. But not yet. Not for this particular thing. Okay. That's my interpretation of this thing that I've built. Everybody's got to get comfortable with their own moving averages. Do the test that I do. The pink should run through the price no matter where it goes. The intermediate term that you use, I'm using a 7-week in this case, stays below it when it's going up, quickly reverses when it's going down, and then stays above it while it's going up. Can be penetrated, but not too often. That's a nice fit. This one is telling me that we're still in an uptrend. Okay, until we're no longer in an uptrend because of stuff that starts happening up here in the days and weeks to come, we will revise that. If this spring back starts again on Monday, we're not going to have to worry about that question. Okay, now we're going to take the price off. Now we're going to change to energy, a very interesting and very volatile part of the Dow Jones, the S&P, the NASDAQ, and the Russell. It affects everything we do, but now we've broken this out of the indexes and we're only looking at this as a standalone. This happens to be the IYEs, which is the iShares US Energy ETF. You can look it up, see who's in it. But this is some pretty wild swings compared to everything we've looked at, including indexes. It will get a lot wilder as we look at other things. But notice that it bears no resemblance to any of the charts we've looked at. Here is the downturn that we had in 2014 and 2015 that was basically a flattening of everything we've looked at. This thing started down all the way here, clearly was in a bear market and had struggled for a long period of time to get out of it. It gave you little periods of hope that when you see this happening, you know that price is going up, above, below, above. Then it tried to get going and was actually in a mini bull market with these above each other, but quickly came to an end and then collapsed again, over and over again. Therefore, it's a very important difference from other sectors when trying to diversify a portfolio. You either want to be out of this thing because it's a drag on what you're trying to achieve, and you've already got all these stocks in the big indexes. To a portfolio, when this is happening as a sector, counter to what everything else is doing in bull markets and indexes, but you're being weighed down by this sector, is you want to have puts or go short the iShares US Energy against your portfolio. What that does is it negates the stocks you've already got in your portfolio in various big indexes. And we will do a vlog. It won't take a whole webinar, but we'll just do a vlog on that subject that you can use as you go from big indexes to smaller indexes, the smaller indexes to offset things going on in the bigger index by going on the opposite side of that trade. When you move out of, excuse me, indexes into sectors, you can find sectors that are doing better than the indexes, and you want to buy them to add value to your 60% out of your 25%. You're using that to eliminate risk and to increase return in the 60%. And by doing that properly, you have increased your portfolio to 85% of X, whatever it is, in your retirement account, your personal account. You've just integrated Consensio's work into the building of a portfolio that is better than simply buying and holding an index. Okay, very important points, but we don't have a lot of time and we've got lots of charts to look at. So that's energy. I want to now look at financials. This is the financial sector, which is made up of all the other industries I've already named. And it had been doing extremely well, meaning that at the end of last year, the short and intermediate term moving averages were way above the long-term moving averages, which means we've got to look at price to understand why would that be. And this is why it would be, because basically we ran from 120 up to 140, 20 on 40 in a very short period of 2 months. But ever since then, we've gone flat, not only with price, but notice how all the moving averages have come together and are going sideways. We tried to break out for a very short period of time. We did not get back up to these highs. And now things are rolling over. And this is not a good looking candle compared to all the other candles we've looked at, except the first consumer one we looked at. This entire candle this week has been below the long-term moving average. The short-term moving average is now cut through the long-term. Financials are not the place to be. It is not in a full-blown bear market, and it's so important for all the other sectors that this has got to get you to sit up and think a little bit more about what the big indexes are telling you, particularly because the big indexes are being controlled by large cap growth, mainly in technology, mainly with a dozen stocks. This sector is much broader. It's all the brokerage firms, all the banks, all the small banks, the big banks, the insurance companies. Everything is thrown into this. You need to break it apart when you get down to the industry level. Let's take it back and see how it looks as you get into the corrections in 2014 and 15. Very long, protracted sideways movement with prices above, below, above, below, above, below, over and over again, a downturn, and finally a great bull market. I'm going to take the price off, and I want to analyze why you would have gotten back into this regardless of what this thing is called. If you take the price off, you look at this activity, you're in it as long as the blue line is going up and these other things are coming down and touching it and hitting it and touching it and hitting it, but then quickly bounce back above it. Now here in this period, you go into a bear market. It did not last long. Let's call it from early fall of 2015 until the summer of 2016, you're in a bear market. You should have either been out during that 9-month period or shorted this sector against the other sectors that were all going up in the form of the indexes to take the sting out of those indexes. So they're not weighed down by the fact that they've got these things in them that are pulling you down. By just taking one option, one put, you can offset a very large portion of that. We'll talk about in more detail. But now let's look at getting back in. Going from a trend that was up to flat to down, when would you get back in this using Consensio? Well, go back to when you examine the first part that we talked about. Take a look at when the short-term moving average moves up. Take a look when the intermediate term moves up, and why is it moving up here? Well, you know price is up here somewhere. That's the only way you get the short and intermediate term to move up. So price is up here, and now this keeps going up and up and up, and both of them cross through the long-term moving average, which is doing what? It's still moving down. It's not time to get in. It's time to take off the puts, though. But what happens is the short term quickly turns down again. Let's take a quick look at price and figure out why that happened. It happened because this little 1, 2, 3, 4, 5 Elliott impulse off the bottom ran out of gas, and we quickly dropped back below everything. Quickly reestablished in terms of price right here. We didn't know that because we're not looking at price, because we don't care. Don't tell me what to buy. Tell me when to buy it. And the when is when all three of these are back in line and the long term is moving up. You don't need to know where the price is. This chart just tells you where the price is. The long term cannot move up unless the price is back above it. And you've already gotten a hint because of the canary in the coal mine, which is now hitting highs, above highs, above highs, above highs. That's why you've got a short-term moving average. You want to be able to get in and out before the damage is done in increments. Okay, so that's the US financials right up through today. Let's move it back so we don't have a clue of what these things are telling us, and let's move to healthcare. No questions here. Long-term bull market, and it's accelerating to the upside right up through the end of today. We don't know what the price is, we don't know what we're looking at, but we know we want to be in it. Let's go back and see if that's been true and for how long it's been true. Well, here is a problem that did not show up in many of the indexes, and that's going into 2017, long after the 2014-2015 problems. And if we take it back even further, we see basically we went through a very prolonged period that started at the same time that everything else, including indexes and the other sectors we looked at, ran into problems. This one did, and it kept it up and then gave you a false move up that then flattened out. You can figure yourself by pulling this up, if you use TradingView, go through these charts the way I am, take off the names and all the rest, and figure out when and how you would have gone in and out and what kind of percentages you would have wanted to do it with. But you do know that right here, without looking at price, you want to be fully in this again. I said, looking at the very recent term, we've got some problems, and here's why. This sharp drop down, and I don't care which stocks did it or what the story was or what was in the newspapers. All I know is that the stocks that made up this iShares US Healthcare ETF, 1 or 2 or 5 or 10 of them, tumbled enough to bring the short and intermediate term down below the long term, but did not turn the long term down. That's very important. You should never have been out of 100% of this, but you should have lightened up your position with this, meaning the short term breaking below the long term, and definitely when the intermediate term broke below the long term. How much? 5% on each of those moves, 10% on each of those moves, maybe. But the long term was still moving up when those first two things occurred. So not a whole lot more than that. I would have probably done those 2 5s, and I would have thrown in a 10 on top of it, or 20% altogether when we broke through the long-term moving average. The fact that both of these then bottomed out with the canary in the coal mine first, as it should and always will, and quickly cutting back through the intermediate term and shortly thereafter through the long term, you're back in with this crossover. You've taken your cash out. It cost you a little bit, nickels and dimes against what you were trying to do. That's the way you use Consensio. But it is matched up to the underlying asset class. These are industrials. You've heard over and over again that been having a lot of problems. It doesn't show up on this chart other than the flattening out of the long term. This is worrisome, but we're still way along from that. I'm not even going to look at the price. You can picture it in your head now if you've been paying attention, which all of you are, and I'm thankful for that. Let's go back just to take a quick look at 15 and 16, same stuff, same thing you saw before. You get back in after the long term has moved up. All three of them are doing the right thing. Each of the moving averages is doing well. We came down here briefly, did not last long enough to take anything off the table. Ran into the problems we just looked at. Okay, don't need price. I don't care what it is. I just care what the trend is. And are the moving averages doing what they're supposed to do relative to the utilities? A lot of people are talking a lot about utilities, mainly because of what we've seen here and here. Relative to all the other charts we just looked at, utilities pay big dividends. Utilities tend to be very defensive relative to other things, but you need to prove that to yourself. Don't just mimic it because you've heard other people say it. One way to prove it is assume that this probably hasn't done as well as some of the other sectors. Well, that assumption is wrong. It's done terrifically well. However, it keeps causing the long-term moving average to flatten out, roll over shortly, roll over, and we didn't see that action in almost any of the other things we saw. So this has a different flavor. Enough of a flavor that we need to take a look at the price and see what is happening that would cause that. And this is where cycles come in. And a lot of people have been talking on CNBC and other things, and this is where Edson Gould really caught on. He did a lot of work with utilities, but just notice we go over 1, 2, 3 bars. We go over 1, 2, 3 bars, 3 bars, 3 bars down, 1, 2, 3, halfway, 1, 2, 3, top, 1, 2, 3, down, 1, 2, 3, 1, 2, 3, up. There is something cyclical going on with this that if you study it, if you take the price away and forget that what you're looking at is this thing called utilities, and just look at the moving average, the longer term, and take a look at the distance between these periods. Here doubled, never got below it, but you got a sideways correction at the midpoint, and then the next top, then the next top, and then the next top. You can try to figure out why the cycle works like that. You can look over decades going back and get a good sense of it. More importantly, you want to break it down into the stocks, see what kind of utilities we're talking about. Is it just some of them? Is it all of them? And in that way, going forward, whenever utilities come up on your radar as something to either protect an account in which everything else is doing the opposite thing without having to buy puts, you can hide in things like this, which since the summer has been moving up and clearly has not moved down nearly as much as the big indexes and most of the other sectors. Okay. We are at 42 minutes, and I am way behind, so I've got to speed this up. And we're ready to do that. I'm not going to do the last one. Maybe I will. Maybe I lied. This is telecommunications. Yeah, let's just take a real quick look. There you go. Been in a downturn all the way for a year and a half. Actually broke out of the downturn recently. We don't know what this is. We don't know what the name of it is. We take away the price. And this is all you need to know. You needed to be hedging all of your other pieces against this because this is in all of your other pieces and it's a drag on your returns. 1 or 2 puts would have done it for you, but you should have taken those puts off, put them on things like the consumers we just looked at, and maybe even bought calls or doubled up on this position because it is holding up so well relative to your 60% and relative to your 25% in other sectors and other industries. And with that, we are going to go to individual stocks. And we've got a lot of them. And I just want you to look at, in the next 15 minutes, this end of the chart, because this is going to answer a lot of your questions about what a lot of these things are doing. I need to move this down to here. I need to go up to this one. This is Tesla. What is Tesla doing right now? It's in a bear market, period. We don't know it's Tesla. I don't care what the price is doing. Now, I'm not going to go into the analysis of why I think this might hold these levels. That's a different topic. It's company specific. It's Bitcoin specific. It's one piece of the 15% of your portfolio that you've got to go beyond what Consensio is telling you. You've got to bring in many other indicators and many other things. If you go back far enough on Tesla, you will see that at the 250 level, there's tremendous support. You will also see that if you connect these lows with these, that there's tremendous support at 250. So if you hadn't bought it, I would wait for it to hold at 250. If you are in it, I wouldn't panic out of it unless it closes below 250. That's all I'm going to say about that. That is not advice. That is telling you that when you move from the 60% bucket into the 25% bucket and all the way down into the 15% bucket, you're going to get wild volatility that's going to take a lot more analysis and a lot more of your time, but the starting place should always be Consensio. Now let's take a look at Amazon. Is Amazon in trouble? Nope. That's all you need to know. Google. Is Google in trouble? Maybe. These are coming down very quickly, but the long-term moving average has flattened. How can that happen unless price of whatever this thing is, which we don't know because we don't care, has dropped below it? You knew that had to happen without knowing this was Google and without looking at the price, because you can't flatten a long-term out unless price is below it. Let's look at Facebook. Is it in trouble? Yes. Let's look at Apple. Is it in trouble? No. When I say is it in trouble, I mean, should you be worrying about it? Should you be jumping out of it? Should you be reducing exposure to other things because of what is happening in the news or what someone is saying, selling their book on television or in the newspapers or in the media? There is no reason to worry about this chart. You are in a long-term uptrend. Microsoft, long-term uptrend. Cisco, long-term uptrend. Little more volatility. Take a closer look by going back further. Try to figure out if this is significant. Comcast, trouble. If you're in it, you shouldn't be. You wouldn't be if you were using Consensio. That's not enough. We're talking about 15% of your portfolio. Hopefully, only 1 or 2% is in something like this. You got caught, you went on vacation. It's a long vacation. You've been gone since the beginning of 2018. You didn't care because you had all this other stuff in the 60% and the 25%. You didn't have to look at it. We're looking at individual stocks, things like Bitcoin, things that move very rapidly, sometimes individual mining shares, individual oil companies. This is FedEx. The reason I put this on here is because FedEx tends to be a leading indicator of the US economy. It tells you what Amazon is doing, but it tells you what is being shipped, how many goods, how many services. And it peaked back here. And you've got tops below tops below tops on the moving averages, and things are beginning to look nasty. I don't need to show the price. You know what it has to do to turn price down. You know where the price is. Don't marry yourself to the name or the price. This is Intel. Looked awfully good until recently. It does not look good now. And you know why. You can write down all the reasons without looking back, without putting price on. Netflix. Very surprising. Very surprising because we have people that are shorting it and making money. How can you be shorting it and making money with this kind of action? Okay. I said I wouldn't do it, but I'm going to because this is important. At various times, you need to use other sorts of indicators. The indicator we're using here, even though Consensio hasn't given you the signal you need yet, is because this is a hyperwave. This is phase 4 of a hyperwave. This is phase 5 and you are out. This is come all the way down to here. This is phase 6. You've covered your shorts or you've hedged your shorts. You might have even played this long. It has now run out of gas and it's coming back down. Is it too early to say that this is going all the way back down to the bottom of this chart? Maybe. That's for a hyperwave discussion. We are debating it. Some people are playing it in our hyperwave group and have done very well, but it's not an easy thing to do, particularly when Consensio is so far behind the curve on this. Trying to find out why it is. It's not the pink line. That's working perfectly. It's not the orange or gold line because that's working perfectly, meaning in uptrends, prices above it, downtrends, it's below it. So it's got to have something to do with the long-term trend being too far away from the action. We didn't know that though, but we did have another tool, and that's why you use other tools. This one is called Hyperwave, and it gave us signals. And each technical indicator you will learn gives you more information than other ones under various circumstances. What I have found is Hyperwave always is the most important of all the technical signals you can get. and it overrides all the other ones. Okay, enough of that. We're going to move this back up. And we are going to go on to square. Still looking good. This is nasty. We broke down through the long term. We're closing well above it. Would I be taking some money off of it? Probably not. Would you? Probably, or maybe. That's up to you. You understand what the implications are. Put in the context, this is 15% of a portfolio. If you've got 15% of your money in this one thing, then absolutely you want to lighten up on it. It's your whole speculative piece of the whole pie, and it's not looking perfect. If you've got 1% of your money in it, and you've got 14 other things in the 15% bucket, you've got plenty of time because everything else you're still doing well in. Okay, that's the way you look at the sizing, is just what I went through. Okay, let's go to Micron Technology. Very interesting. It's just turned negative as opposed to a lot of the other things we've seen. We know where the price has got to be. It is now in a full bear market. AT&T, it's been in a bear market for a long time. But guess what? Just like the utilities, something funny is happening here at the end. It's time to explore that. A biomed, no comment. You can tell. BlackRock, very important chart because of the size and the influence of BlackRock. No comment. You know as much as I do until you look further. NVIDIA, no problem, except this is very interesting to me. Without looking at price and knowing what we're looking at, we are in a bull market, but how in the world did that flatten out? You know the answer to it. You can't flatten out unless the price is below that moving average. We didn't need to look. You knew that. I'm not saying be ignorant. I'm not saying you've got all those other tools, all kinds of other technical stuff. Of course you're going to look at price. What I'm saying is you don't need to, and you will draw the same conclusions with this very simple system. Visa, no problem. Very interesting. These are the marijuana stocks. This is CanTrust. It does not correlate to anything we've looked at before. It has not been around very long. How do you know that? Because this is where the long-term moving average starts. That means it wasn't around long enough. This is called a FRIA, also a marijuana stock. This is CGC, also a marijuana stock. We have just defined an industry by looking at 3 stocks. Those 3 stocks could be in your 25% bucket as an industry under agriculture. And under agriculture, small piece called marijuana, smaller piece called medical marijuana that is only wholesale to pharmaceutical companies. But what I'm telling you is don't get married just to the idea of a stock. When Consensio gives you clues that several stocks in the same grouping are doing something differently that can help the overall portfolio, particularly when that overall portfolio is going through a difficult time, things like this can be a stopgap measure. Somebody asked me if I wouldn't bring this up. This is the last one we're looking at because we've still got a couple of minutes. This is General Electric. Are you kidding me? If you've been in this at all, you have been. If you were in the Dow Jones, you are no longer because it was taken out of the Dow Jones, but it's definitely in the S&P 500 and it's in like every other index. Doesn't correlate to anything. You are out here. You have been out ever since. I'm not going to try in today to answer when do you get back into something like that. You can hear all the fundamentals. You can hear about the new CEO. You can hear about the outgoing one. You can hear about the great CEOs that were around before. You can look at all the numbers in terms of profits and growth and sales and revenue and margins. Or you can wait for a simple signal that will get you back in long before this thing starts moving up again. And with that, I am through. I've got less than a minute to go. I want to thank everybody that stuck with us. I'm going to stop sharing, but I can pull up any of the things we just talked about. We've still got 100 people. You people are fools. This is a Friday night, and you're sitting there. Hopefully all you're doing is, well, thank you very much. We are honored to have you. Thank you, Leah, for getting this all set up. Thank you, Tone, for helping us along the way. This is a big day for us. We have gone outside of our comfort zone of the last 7 or 8 months. And so far, I really like what we've seen. So hopefully, we're going to do many, many more of these. And we would like any and all of you to let us know what subjects that you've heard us talk about or that you have not, that you would like more in-depth analysis to help you put into perspective some of the things I've been talking about. And with that, I believe I can just sit here and all of the work is going to become my partner. She does all the work before and after and in between. And chat is got a lot of stuff in it, a lot of questions. Okay,